Good day to one and all. My name is Christopher Ng Chung. I'm the Early Retirement Masterclass Trainer under Dr. Wealth, and today I'll be covering dividend stocks outlook for the year 2022. Right, for today we will first go through a very general outlook for 2022, and then we will talk about how we can actually leverage these trends when it comes to dividends investing. All right, so we'll be divided into two parts. All right, first of all, let's talk about the two major trends that's affecting us right now as we move into 2022. I think that there are two major trends. The first trend is recovery from COVID-19. Now, I understand that right now we're facing a Omicron sweep where the latest strain of the virus is basically wreaking havoc around the world. But there are several things to be optimistic about. The hospitalization rate is relatively low as well as the death rate. So I expect matters to be greatly improved when Singapore as well as other countries were to deploy the Pfizer COVID-19 pill. And this is likely to reduce hospitalization rates above 80%. Now, if you agree with me that this is likely to happen, then this is an extremely bullish trend, in particular for dividend stocks in the recovery sector. So we can expect very bullish outlook for travel as well as hospitality counters, right? The second trend that I think would be very important as we move into the new year is rising interest rates. Now, the US Federal Reserve is expected to taper their bond purchases this year, and we should also be expecting 2 to 3 interest rate rises before the year has ended. All right, and this also ensures that inflation is expected to be on the high side in 2022. Okay, so the rising of the interest rates would be used to actually offset inflation in most of the economies that we see around the world. And rising interest rates, generally speaking, are bullish for banks and any real estate investment trust that can find a way to convert higher interest rates into higher rental fees. Okay. So these two major trends, all right? Remember this, and let's talk about how we are going to invest based on these two trends. So the first trend that we're going to talk about is recovery from COVID-19, okay? And I think what we can do as dividends investors is to look at the hospitality trusts, which are stapled securities that combine features of real estate investment trusts as well as business trusts. This is a safe, conservative approach, all right? And if you look at the 5 hospitality trust counters we have in Singapore, you can actually get all of them in equal shares so that you can benefit from a broad-based recovery. Okay, so let's look at the 5 hospitality counters that we have. The largest counter is Ascott REIT, Ascott Residence Trust. The symbol is HMN. And for most conservative investors, buying this trust right now would net you a current yield of about 4.44%. The target price, 119, is actually higher than the current price that we have, which means that this is probably the safest way for you to take advantage of the recovery from COVID-19. Now, beyond Ascott Residence Trust, there are 4 hospitality trusts that you can buy, but keep your allocation small and in equal parts. All right. Right now, the dividends for these counters is not particularly high. It ranges from 0% for ARA Hospitality Trust to about 4.2% for Far East Hospitality Trust. The whole point about getting these hospitality trusts at a low yield is to benefit when dividends recover this year. All right. If it doesn't recover this year, it might stretch to the year 2023. But what we're seeing here is that, very generally speaking, the price that you can buy these counters at would probably be lower than the target price that's actually stated by the analysts. Right? So this is a very good way to play the recovery from COVID-19 for conservative dividends investors. The next trend that we want to talk about are rising interest rates. And we know that banks have been backtested to outperform the STI ETF when interest rates are rising. And as all the 3 banks have a very high correlation with each other, about 0.7 to 0.8, it may be meaningless to buy one specific bank. So what you can do as a conservative investor is to simply buy 3 banks in equal shares. All right. Currently, the current yield for each of the bank is not necessarily high. All right, DBS is going at about 3.12, OCBC at about 3.59, and UOB at about 3.68. So all three are yielding slightly below 4%, but we can expect dividends to be increased as banks find a way to actually squeeze a lot more money out of the people who have home mortgages, right? So when interest rates go up, people will have to pay more money to service their home loans, all right? So this is actually very bullish for people who are invested in our local banks, right? The target price from the analyst is therefore fairly high at $37 for DBS, $15.35 for OCBC, and $21 for UOB. All right. So if you were to buy all these three in eco shares, once again, all right, it's a very, very safe bet to play the Singapore stock market in the year 2022. All right. In summary, these are the plays that are thematic in nature. So the current yields right now, when you actually invest in these counters, isn't going to be fantastically high. Okay, but I think what's important is that we are playing a little bit of dividend growth as we go through 2022. All right. In the early retirement masterclass, we will combine stocks that benefit from rising trends, all right, with stalwart dividend yield counters that provide a higher but more stable cash flow. Right. For the folks who are actually looking for something with very, very high dividends, look no further than United Hampshire REIT, which is a REIT that basically focuses on US grocery stores. It has now been beaten down rather badly and currently yields about 11.7%. All right, that's all I have for you today. Okay, have a wonderful and happy new year, and I'll see you on the next video. Thank you very much.